We live in a world where some people can take huge risks, make big mistakes, and still walk away unscathed, while others face ruin for even small errors. In finance, this phenomenon is called moral hazard. The term moral hazard originates in insurance and banking. It describes a situation where someone takes on risk because they are insulated from the consequences. But the rich, they take it further. Their wealth doesn't just insulate them, it actively rewrites the rules of risk, allowing them to operate in a world fundamentally different from ours. Think about it. For most people, making a financial mistake can mean losing a home, a job, or years of hard work. For the ultra-wealthy, the same mistakes are often just minor setbacks, or even tax-deductible learning experiences. This isn't luck, it's structure. Legal frameworks like limited liability allow corporate owners and executives to separate their personal fortunes from the risks of the companies they run. That means a hedge fund manager can make massive speculative bets with billions of other people's money, and if it fails, the worst-case scenario rarely touches their private wealth. Meanwhile, the people employed, invested, or exposed to the fallout bear the brunt. It's also embedded in financial instruments designed to magnify gains while minimizing losses. Derivatives, collateralized debt obligations, credit default swaps. They are tools that allow risk to be offloaded, repackaged, and sometimes hidden entirely. During the 2008 financial crisis, banks and hedge funds piled into complex mortgage-backed securities, fully aware that any collapse would likely trigger government bailouts. The lesson? When you are too big to fail, risk is a game with asymmetric consequences. Massive upside for you, catastrophic downside for everyone else. Then there's behavioral finance, which explains why the rich can act this way without even thinking about it. Concepts like loss aversion, the idea that humans fear losses more than they value gains, don't apply the same way when you have immense wealth. Losing $1 million may be devastating for the middle class, but for a billionaire, it's often insignificant in the context of a portfolio worth hundreds of millions. The diminishing marginal utility of wealth is real. Each additional dollar matters less emotionally and psychologically. This creates a buffer against fear, allowing the wealthy to take risks that ordinary people wouldn't dare. Wealth also comes with political and social capital. The rich influence regulatory frameworks, tax policy, and corporate law to favor themselves. Lobbying, campaign contributions, and elite networks create feedback loops where money translates directly into protection. The rich can craft rules that exempt them from consequences the poor or even moderately wealthy must obey. Look at tax loopholes, offshore trusts, or carry structures in private equity, which allow enormous wealth to be shielded from standard taxation. They can lose millions in high-stakes speculation and still emerge untouchable, while ordinary families are ruined by far smaller financial missteps. The historical perspective makes it even clearer. Think of the robber barons of the 19th century, or modern equivalents like tech billionaires and hedge fund magnates. They consolidate wealth, exploit legal frameworks, manipulate labor markets, and leverage political influence. Their failures rarely ripple down to their own fortunes. The consequences almost always fall on employees, shareholders, or society at large. Moral hazard isn't just an abstract concept. It's woven into the DNA of how wealth functions in our society. Even access to opportunity is a form of moral hazard. The wealthy can experiment with financial strategies, invest in high-risk ventures, and recover from failure because they have diversified portfolios, access to privileged information, and networks that provide second chances. Ordinary people do not have this luxury. One poor investment or one health emergency can be catastrophic. For the wealthy, failure is a learning tool. For the rest, it's a punishment. This is why wealth perpetuates itself. It insulates risk, concentrates power, and multiplies opportunity, while scarcity amplifies risk and limits mobility for the poor. Insurance and social safety nets reinforce this divide. Banks, corporations, and hedge funds operate knowing that systemic risk will trigger government intervention. This is not an accident. It's part of a larger structure where moral hazard is institutionalized. Bailouts, liquidity support, and emergency funding are effectively ways society absorbs the costs of wealthy risk-taking. Ordinary people rarely get that luxury. If a poor family loses their home, society doesn't step in to make them whole. If a billionaire loses billions of dollars betting on exotic financial instruments, they often profit anyway. And if they fail spectacularly, well, the government often steps in. Moral hazard is embedded in policy as much as it is in wealth. Then there's the psychological dimension of status signaling and social perception. The wealthy are often judged for extravagance, not recklessness. A hedge fund manager taking huge risks is innovative, while a middle-class worker doing the same is irresponsible. Society normalizes moral hazard at the top because wealth confers legitimacy, even when it shields people from consequences. This is amplified by media narratives, cultural framing, and public perception, which glorify the risk-taking of the rich while ignoring the fallout for everyone else. Global finance extends moral hazard even further. Sovereign debt, currency speculation, and cross-border investments mean that wealthy actors can shift risk onto entire nations. Developing countries may bear the consequences of financial speculation they never controlled. The rich profit from emerging market debt, derivatives, and currency swaps, and when things go wrong, it's the poor and the middle class in those nations who pay through austerity, inflation, or unemployment. Moral hazard isn't confined to the individual, it's embedded in international financial systems. What's important to understand is that moral hazard isn't just an ethical issue, it's structural. It's not a mistake that wealthy individuals or corporations operate under different rules. Insurance, limited liability, derivative markets, tax shelters, lobbying, and bailout policies are all designed explicitly or implicitly to allow this behavior. The wealthy don't just benefit from moral hazard, they rely on it. And the rest of society pays the price, whether through lost jobs, crashed markets, reduced public services, or systemic inequality. Yet, this is also where education and awareness can make a difference. By studying moral hazard through lenses like corporate governance, behavioral finance, regulatory policy, and global economics, we can identify where risk is misaligned and propose remedies. Progressive taxation, corporate accountability, and stronger regulation can reduce the asymmetry. Transparency, public oversight, and systemic checks can limit the consequences falling disproportionately on the poor. Moral hazard is not destiny. It is a structural feature we can reform if society demands accountability at all levels. The moral hazard of wealth is not abstract. It's visible in our financial markets, corporate law, political influence, and global capital flows. Wealth allows the powerful to operate outside the rules, take risks ordinary people can't, and emerge unscathed when those risks fail. It perpetuates inequality, concentrates power, and insulates the wealthy from consequences the rest of us face. Understanding it requires knowledge of complex finance, history, and behavioral realities, but it is not beyond our grasp. The moral hazard of wealth is real, pervasive, and structural. And until it's addressed, the rich will play by different rules while the rest of us pay for their mistakes.